So if you're a property investor, you know there's this one huge decision that pretty much shapes everything else: your income, how much work you have to do, and even your lifestyle as a landlord. And that's the big choice between short-term and long-term rentals. Today, we are going to break down exactly which path might be the right one for you.
So, which is it going to be? Are you going to jump into the fast paced, high energy world of short term rentals? Or are you going to take the steady, more predictable path of a long term lease? This is way more than just a simple choice. It's a huge strategic decision that really has to line up with your financial goals, your property's location, and honestly, even your own personality.
To help you figure this out, we're going to tackle it step by step. First, we'll get clear on what we're even talking about. Then we'll do the fun part and follow the money, looking at both income and costs. After that, we'll get real about what it takes to manage each one. And finally, we'll put together a kind of scorecard to help you make the best choice for you. Okay, before we can really pit these two strategies against each other, we need to be absolutely crystal clear on what we mean. So let's lay down the ground rules and define the two main contenders in this rental game. First up, we have the short-term rental, or STR for short. This is the model that powers sites like Airbnb. We're talking about places that are usually fully furnished and rented out for these short bursts of time. Anything from a weekend trip to maybe a couple of months. It's super dynamic, with a lot of guest turnover and prices that can swing wildly depending on the season. And then on the other side of the ring, you've got the classic long-term rental, or LTR. This is your traditional lease, right? Usually for 6 months, a year, maybe more. This whole model is built on stability. You've got a formal contract, a fixed rent payment coming in every month, and a tenant who actually makes the place their home for a while.
All right, so now that we're all on the same page with the definitions, let's get to the part I know everyone's been waiting for: the money. Which one of these strategies is actually going to put more cash in your pocket at the end of the day? Let's follow the numbers and find out.
Now, this is where it starts to get really interesting. This little breakdown shows you the core differences at a single glance. You can see the STRs, on platforms like Airbnb, have that flexible, dynamic pricing, but they demand a ton of your involvement. Then you contrast that with the LTRs, formal leases, fixed rent, and a much more hands-off approach. This right here really sets the stage for everything else we're going to talk about. And wow, this chart just perfectly illustrates the income story. Just look at that steady, flat line for the long-term rental. That is predictability. You can pretty much bank on that income month in and month out. But now, look at that blue line for the short-term rental. It's a total roller coaster. You see these incredible peaks during the high season. We're talking potentially earning double or even more, but you also see those dips in the off-season. So yeah, the potential is high, but so is the volatility. But wait a minute. It would be so easy to just look at that graph and say, yep, STRs are the clear winner. The problem is that top-line revenue, it just doesn't tell the whole story. Because as this slide points out, that higher income almost always comes with much, much higher costs. Right, you have to factor in all the operational costs. And this is where these two models really start to pull apart. With STRs, you're the one paying for constant cleaning between every single guest. You got higher maintenance because of all the wear and tear. You're probably covering all the utilities too. And don't forget the marketing and management fees. All those things can really start to eat into that impressive revenue. Money is only one piece of this puzzle. Now we've got to look beyond the spreadsheet and think about the human element, the time you're going to spend, the effort you have to put in, the risks involved, and just the overall lifestyle that comes with each of these strategies. The biggest pro for STRs is pretty obvious, right? That potential for higher earnings and the flexibility to, say, use the property yourself sometimes. But the downsides are real. It's incredibly time-consuming, almost like a part-time job. And you're always at the mercy of changing local regulations. LTRs, on the other hand, they offer that beautiful, stable, mostly passive income with way less management hassle. But your income potential is capped, and you've got a lot less flexibility. Okay, so how in the world do you weigh all of this and actually make a decision? Well, there's no single right answer that works for everybody, but there is a right answer for you. Let's try and build a little personal scorecard to help you find that perfect fit. The short-term rental path is probably for you if you're really chasing those higher returns. And, this is key, your property is in a prime location, like a tourist hotspot or a business hub. You also have to have the stomach for an income that can swing up and down. And most importantly, you have to be ready to run this thing like a small hospitality business.
Now, on the flip side, long-term leasing is your game if your whole philosophy is slow and steady wins the race. You're someone who prioritizes passive, predictable income over squeezing out every last drop of profit. You want lower risk, less hands-on management, and you'd rather have a good night's sleep than chase that peak season pricing.
Let's actually put some real numbers to this to make it concrete. So, as you can see here, a property might earn a very predictable $21,600 a year as a long-term lease. Now, that same exact property, run as a short-term rental, could gross a much bigger number, say $36,000. But after you subtract all those extra costs we talked about, your net income might land somewhere around $29,000. So what's the bottom line? Well, even with all the extra work, you could still be looking at a 20 to 40% uplift in what you actually take home.
And that right there really brings us to the core takeaway of this whole thing. It's never been a question of which one is just better in a vacuum. It's all about taking a hard look at your own goals, your market, and what you're capable of to find the strategy that truly aligns with you.
So before you make a move, just run through this final checklist. First, what is the demand really like in your location? Second, be honest with yourself. Do you have the time and energy for all the operations? Third, and this is a big one, what are the local laws? And finally, get real about your financial goals and your own personal tolerance for risk.
Because in the end, this choice really does go deeper than just the property itself. Are you a hands-on entrepreneur who wants to build a little hospitality brand? Or are you a strategic investor who's building a portfolio of stable, passive assets? The real question is, what kind of investor do you want to be?